In today's market update, we're going to be continuing the analysis that we've been tracking over the last month or two. In these market updates, we're going to be looking at the S&P 500 again, and I'm going to be speaking about how bullish is the market at the moment with the bounce out of the 20-week cycle, which I believe formed at the beginning of June. Today is the 13th of June 2019. My name is David Hickson, and as always, I must ask you to please make sure that you have read these disclaimers. Here is the chart of the S&P 500. This is the analysis that we have been tracking. And of course, the most important feature in terms of our discussion at the moment is the fact that an 18-month cycle trough formed at the end of December, round about Christmas time last year. And in our recent market updates, I've been speaking about the expected 20-week cycle trough, which you can see in this analysis has now been phased at the beginning of June. So that is almost certainly the 20-week cycle trough. In our previous market update, you might remember that the 20-week cycle trough had already been positioned by the analysis and sentient trader as having occurred in early May. But if you haven't seen that video, I would encourage you to go and look at it. It's the video that I posted on the 28th of May, and I discussed reasons why it was very possible that the 20-week cycle trough might form a little lower than that trough that had already been identified as the 20-week cycle trough in the middle of May. So I'd like to speak just for a moment about that concept of the fact that sometimes in a Hurst cycles analysis, you will mark a particular trough as being a trough of a cycle, but yet you need to keep your mind open to the possibility that the trough is still going to happen. It's something that some people struggle to deal with. Obviously, when we are making trading decisions, we are looking for certainty. We're looking for black and white situations. We're looking for the opportunity to say, yes, with absolute conviction, that is the trough of the 20-week cycle. And if you take a look at the video that I posted in the previous market update, you will see the various reasons why I believe that that trough was not yet confirmed. Hurst cycles analysis is more of an art than a science, in my opinion. In fact, that is something that Hurst himself said. And so it's always very important to be aware of all those subtleties. It's very rarely a purely black and white situation, and you have to be open to exploring the cycle tools that are available to you and the other means that we have of assessing an analysis situation and determining whether a trough has formed or whether it might still be lying ahead. So if you haven't seen that video, please go back and look at the previous market update. Let's speak about what is happening now. As you can see, we now have a 20-week cycle trough below this price low at the beginning of June, and that is, in my opinion, almost without question, the 20-week cycle trough. As explained in the previous video, I was not going to be surprised if price dropped down a little lower than it had been in the middle of May, at which point the 20-week cycle trough would form on the basis of the interaction between price and the 20-day FLD. So we're going to be taking a look at that in a moment. The FLD that I have on this chart is the 20-week FLD, and you can see, of course, the points at which price reacted to that 20-week FLD as discussed in my previous video, and then it came down and eventually formed its 20-week cycle trough below that 20-week FLD. This is an example of how markets interact with FLDs. We have an expectation of what's going to happen. Very often a 20-week cycle trough will form at the level of the 20-week FLD, but sometimes it'll drop just a little bit below it. I often say, you might know that I have a background in film as a writer and a director. And there's a saying in film circles that you give the audience what they expect, but you do so in an unexpected way. That's what makes for a very satisfying film watching experience, because you're expecting a thriller, for instance. So you expect to be thrilled, so you need to give your audience that thrill, but you need to give it to them in an unexpected way, and that's what makes for a good film. And in fact, the same thing, I believe, happens in the markets. So we always have what we expect happen in the markets, but it often happens in an unexpected way. And this is an example of how that happens. We expected the 20-week cycle trough. It happened in a slightly unexpected way, which is what always happens in the markets. So let's take a look now at this 20-week cycle trough and what has happened since then. So let me zoom in and let's just consider the very recent action. And I'm going to stop watching the 20-week FLD. Its usefulness has passed, and I'm going to display my favorite FLD, which is the 20-day FLD. And you'll know that interaction between price on an end-of-day basis and the 20-day FLD is a very reliable way of tracking what is happening in the markets. And so if you are familiar with the sequence of interactions that happen between price and the FLD, then you will know that following a trough of 80-day magnitude or greater, and of course the 20-week cycle trough is a trough 1 degree greater than the 80-day cycle trough. And so following that, the first interaction that happens is an A category interaction. Now, when an A category interaction happens, we can generate a target. And that target is measured from the low of the price up to the level at which price crosses the FLD. So we can actually measure or discover the low at that bar over there. And that low price is 27.2880. So let me write that down quickly. And the level of the FLD at the point at which price crossed it was about 28.30. So we generate our target by subtracting the level of the low point from the level of the price cross, and we get a difference of 101.2, and therefore our target is 2931.2. So that is the target of our A category interaction. Let's see how price has fared. Here is the low point. Here is the crossing point, and 29.31 over here was our target. So this is an A category interaction. Now, A category interactions usually fulfill their targets. They usually reach their targets. The fact that this price move has come up towards the target but has since struggled. You can see this week, Monday, Tuesday, and Wednesday of this week, we have data going up to the end of the 12th of June, and price is struggling to get any higher. It might still make it, but it looks as if though it has failed to achieve that target. So that's a really useful and interesting piece of information, because if the A category trade fails to reach its target, it indicates that the bullishness of the market is diminishing. So what are we expecting next? I have some more to say about the bullishness of the market, and we're going to come back to it in a moment, but what do we expect next? Well, the next interaction between price and the FLD is the B category interaction, at which point price will come down to the 20-day FLD, at which level it is expected to find support. When is the B category interaction expected to occur? It usually happens at the time of the first 20-day cycle trough following the start of the sequence. So here you can see the nest of lows for that 20-day cycle trough. So what we are expecting is for price to come down to the FLD and to find support, and thereby form its B category interaction. Now, of course, price might continue rising up. It might fulfill its target, which would be a more bullish indication, and then it might turn down and only find support perhaps at this kind of level over here. But the important thing is the structure of the move that we are expecting. Now, we wouldn't at this stage enter a short trade, because you don't trade short usually for the move back to the FLD. Of course, if you're a very aggressive trader, then you might do that. But generally speaking, you're looking for the bigger moves, the stronger moves, and the move back to the FLD in a B category interaction is not usually that strong, unless the bullishness of the market has shifted in a very big way and the market is no longer bullish, but is actually turning bearish. The only circumstances under which we would be interested in entering into a short trade is if this market has turned bearish. Well, there is no indication yet that the market has turned bearish. When you're working with Hurst cycles, you're not constantly trying to guess what's going to happen. You look at the evidence. And when the evidence is there, you understand what is happening in terms of that market. And there is no evidence yet that the market has turned bearish. It looks as if though our A category trade is over and that it has failed to reach that target. But it might still reach up and reach that target. And whether it does or doesn't, the next interaction with the FLD that we are expecting is this B category interaction. So now, what about the bullishness of this market? What else can we say about the market at the moment? And let's just zoom out a little bit and let's speak about what has been happening to this market recently. When you are considering the bullishness of a market, you look at the shape of a previous cycle. So in this particular instance, we're going to look at the previous 80-day cycle, which started in the first week of March and ended, of course, at the beginning of June. Let's see how many bars that actually was. You can see that was 87 bars, 87 days, so a slightly long 80-day cycle. The average length of an 80-day cycle, you probably know, is 68 days. So 87 is a little bit long, but by no means beyond the realms of possibility. So it's a perfectly good 80-day cycle. How do we determine how bullish that 80-day cycle was? Well, simply we compare the level of the start of the cycle to the level at the end of the cycle, and you can see there was hardly any price movement. In fact, if I display the crosshairs there, you can see that the market over the course of that 80-day cycle moved up by only a few points. So that's not a very bullish cycle at all. The other way in which we determine the bullishness of a cycle is that we look at where the peak occurred and compare the time that preceded the peak to the time that followed the peak to the next trough. So let's do that. We can, in fact, measure those bars exactly. You can see it was 54 days up to the peak, and therefore it was 33 days from the peak to the next trough. So we're looking at a ratio of about 5:3, fairly nice Fibonacci ratio for the formation of our peak. The fact that we have a slightly late peak means that that cycle still had some bullishness to it. So that is how we define the bullishness of a cycle according to a Hurst cycles process. The relative level of the troughs at the beginning and the end of the cycle, and the position of the peak in the cycle. So that is a neutral to slightly bullish cycle. Now, we need to consider the bullishness of that cycle within the context of the bigger picture. So let's zoom out again and take a look at the context of that 80-day cycle. Let me zoom that in just a little bit. So the cycle that we have just determined was neutral or slightly bullish was this cycle over here, up and then down again. And you can see the 80-day cycle that preceded that was a very bullish cycle. There it is over there from the end of 2018 up until early March. So we had a very bullish cycle. And then we had a fairly neutral cycle. Now, those two cycles together formed a 20-week cycle. And generally, in a 20-week cycle, we would, if the initial trough is a very strong, powerful one, as it was in this case, it is an 18-month cycle trough at least. So we would expect a very bullish cycle and then a less bullish cycle. So what do we expect now following this 20-week cycle trough? Well, first of all, we expect a more bullish cycle than the cycle that we have just experienced. And the reason for that is because this cycle is bouncing out of a 20-week cycle trough as opposed to an 80-day cycle trough. So it is likely to be slightly more bullish than this cycle. But then the market is expected to turn bearish because of this 40-week cycle trough that we are expecting to occur sometime perhaps in October or November. As we get closer to that time, we'll be able to more accurately define, of course, exactly when that cycle trough is likely to occur. So in terms of the bullishness of the current cycle, we would expect something that either matches or is perhaps slightly more bullish than the previous cycle, coming down into the 80-day cycle trough over here in about the middle of August, and then we would expect a more bearish cycle following that, bringing the market down into the end of October or November. So that's the bigger picture, if you like, of what we are expecting, but we need to keep a very close eye on it because of what is potentially happening in terms of the peaks that have been forming in this market. Let's quickly take a look at those peaks. If we zoom all the way out to about the middle of 2017 up to the current day and display a peak analysis, you can see that according to this peak analysis, a really big, in this case it's a 9-year cycle peak, is in the process of forming. Now you will know, because I've said this often, that peaks are complicated in stock markets, whereas troughs tend to be simpler. And when a very big peak forms in a stock market, it usually happens as a series of what I describe as rounded and clustered peaks that form in the price action. And that is exactly what you can see happening here. They are rounded, or it is a rounded formation of a peak, as you can see from that rather wobbly line that I've drawn, and they are clustered together. We have a peak there, and a peak there. It's not important that Sentient Trader has positioned the 9-year peak there, because the 9-year peak might just as well be over here, or it might be over here. The exact position of a peak is not really very important, and that's because the principle that cycles are synchronized at their peaks doesn't really apply to stock markets. And so the peak analysis gives us interesting information, but it's not necessarily true that those peaks are synchronized in the way that they are presented on the chart. That's getting a little complicated, so I won't dwell on that, but the important point is that a very important peak is in the process of being formed. And now it is possible that that peak formed here, and then the market moved down to this trough here, and now it is moving up to a yet higher, greater peak. That is perfectly possible, but we need to keep a very close eye on what is happening in this market, because it is also possible that these three peaks together are forming a very important 9-year cycle peak, and perhaps there will even be a slightly higher one coming up. But we need to watch it carefully, because it looks as if though the market might be in the process of turning over, in which case our expectation of the current 20-week cycle trough as being as bullish, if not slightly more bullish than the previous 80-day cycle, might need to be revised. If the peaks have really rolled over and these cycles are turning bearish, then we certainly need to be on the lookout for the mood of the market to turn bearish. And that is why it is important that this A category target has not been achieved. The fact that it hasn't been achieved is a slightly bearish sign. We're not jumping into short trades yet, we're not bearish this market yet, but we certainly need to stay on our toes to monitor the situation. I hope that you found this market update interesting. If you have any questions, please don't hesitate to put them into the comments below the video, or email us at info@sentienttrader or info@Hurst Cycles.